Okay, welcome everyone. We'll start our lesson 4. Today lesson will go through LO4 learning outcome 4. As you know me, my name is Anjum Sata. Please, if you have any question, drop me email anjum@ukeversity.co.uk and I'll try my best to get back to you as soon as possible. Today lesson key focus will be our LO4. We'll start. Please, can we look what we learned during our last 3 lessons? Okay, so during our last 3 lessons, we learn about, we discuss about budget and what is budget and budgetary control. We had a discussion about types of budget. We discuss about financial statement. We discuss about financial ratios. Today lesson, which will be able to recommend effective long-term and short-term sources of funding, and that's the key, which will go through different sources of funding. So that is very crucial. As access, reflect, appraise, and justify. These are the key command verbs today lesson. Really, we need to be focused on these, the command verb. Okay, next we're looking the key indicative contents. Will go through the sources of fund. The funding is very, very important in any business for sustainability. So you have to make sure the measure the risk, measure the purpose, look around the risk and reward, look around the taxation purposes and the effect of you want debt financing and equity financing. Those are very important in terms of the sustainability of the business. So you have to think about what sort of the business is best, in which business is more sustainability. Sustainability means meeting the needs of current generation without compromising the needs of the future generation in the funding, and the project also is quite crucial. Really, we need to be look around. Okay, next we look we look the sources of funds, sources of finance. We can rate 1 to 10. What you know about the sources of fund, where the funds can be, how we can get the financing. So there are the knowledge always good to be reflected. Okay, let's please, we'll start. 4.1 assessment criteria. Assess the needs of the short-term working capital. Working capital also known as the running capital. And working capital is very important in the business. So working capital also known as a liquid. Anything is cash itself or anything which we can convert into the cash is called liquid. So we can look around when and how long the finance is needed. We look around the security that provided. We look around the setup cost, how much is the setup cost. We can look around the starting investment capacity, working capital, running capital. We'll go through those. That is quite crucial. Really, we need to be look around the funds. Okay, anyone, any questions? So you have to think about which business you're in. You're a sole trader, what % business? You're a partnership 2 to 20. You're doing limited company, is the private limited and public limited. So public limited can issue the shares. So if you want finance, maybe you issue the shares. But if you issue too many shares in circulation, what will happen? It leads to the problem of your control on the company, because the shareholders have the voting rights. Those we need to be look around the mission and the value of the company, not contradictory of fundings and working capital cycle. So what is the working capital cycle? Debt and trade receivable, which we have credit sales. So if we are receiving money from 30 days from the customer, we're converting inventories into 10 days and we paying to our supplier in 90 days. So the difference will be our working capital cycle. That's we need to be make sure the working capital cycle is shorter and quick. We can convert into the finished good and we carry on the cash flow problem not happen in the business. Okay, so a business has the variety of the choices to make, and obtain the sources of finance, because always good to be think about, where the money will come from. Look around the levy of the government, from the government. Really, we need to look around how quick the money is needed, so you have to look around. Maybe if you get early money and the money is in your account, it's cost you, because it's called opportunity cost. It's called, present value of, we need to be look around. So those are very crucial, which we need to be So central bank, state bank, so we have to look around what is the base rate at the moment. At the moment, base rate is a 5%. And if you go and borrow money from the bank will give you now maybe uh, 6, 7, 8, 9, 10%, depend on your credit scoring, and you have to look around the costing as well. And other is the time value of money. With the passage of the time, the value of the money is drop. Even you get 10% higher, but what will be the real value of the money? Because the inflation rate, if you go on the website, ONS, Office of National Statistic, which we can look around these, and you can find, how much is the difference there, which we have a risk there. The amount of the risk involved in the reason of the cash, so we can look around the project, which has the less, the chances of leading to the profit, determine more risky than one that does. So potential source of finance can be internal and external within the company. If you have asset, maybe you can sell it, you can generate the money. We can look around the long-term requirement of the good, entrepreneurial judge, whether the finance needed is for long-term or the short-term. You have to decide the period. Okay, short-term finance, which normally, to meet the day in and out needs of the business. And the long term, like, you want to buy a house, you want to buy an office, that's, unable either repay, the loan in the short run, like a mortgage, which is difficult because normally the loan amount is a big amount, big in terms of the value. So we have to look around overdraft, is OD is overdraft limit. We have to look around the suppliers credit, working capital. That's, working capital also known as a running capital. So we can look around the mortgages, we can look around the bank loan, we can look around the share issues, we can look around the debentures, we can look around return profit, hire purchase. Hire purchase, any asset you hire on. So that can be purchased, which we can look around. That's quite crucial, which we need to be look around, like different, the cost and the benefit analysis, share issues, preference fixed, return, ordinary, and the voting right, and 5%. So in the short term, they can be raised the finance through overdraft or the short-term loan. So overdraft is the flexible, can be arranged quickly, like, overdraft, for the shorter period of time, like for 90 days, for 1 year, or less than 1 year. Of course, bank carry on increasing or decreasing your overdraft facilities, and if we don't use overdraft facility, bank can withdraw the overdraft facilities as well, because at the end of the day, they have a commitment. They kept, the money aside, for this overdraft, even you're not using it. Interest rate, we have to keep in mind, normally overdraft, if unarranged, it can be 29-30% even, the per day, overdraft, the charges. So working capital is a capital available to conduct day-to-day business, which is working capital management is always is a quite crucial. Think about inventory. Only buy inventory stock, when you need it. So just in time inventory method, which is given by the Japanese approach, that's quite good. That's quite good to follow, which we can look around. Current asset divided by current liability. Current asset means the asset which is short term, which is like trade receivable, inventory, and prepaid. These are, and the cash itself is an asset as well. So these are current assets. The current liability, which we have to pay within a year, and we have to settle, like, bank overdraft. We look around the trade creditors required, the funding to consider the reducing the levels, and we need the funding to consider the increasing the level. So we have to be keeping in view of the benefit and the drawback, are cause and benefit, cost and benefit, and the risk. Risk is the probability and the chance of happening. So anybody, any question? That's, which we need to be look around. Okay, so guys, now we need to be look around when you looking in terms of the finance. You look the long term, you look the medium term, you look the short term. So long term is the share capital, return profit, venture capital, and the mortgage, and the long term, which we can look on the bank loan. So medium term can be bank loan, lease can be 5 years, 10 years, and a higher purchase of the government grants. And overdraft, can be short term, trade creditors, or invoice discounting. Factoring is also these approaches we can use. So please, when you look, in terms of the finances, always look around each, advantages and disadvantages. Of course, overdraft is a short period of time. It's quick, meet the short-term obligation if you need, to meet it. And interest rate repay amount can be overdrawn, or it can be expensive. So type of the bank, the banking system, clearing bank, retail bank, merchant bank, they offer, the payment mechanism to provide the place on. If you're dealing with the foreign currency, so you have to think about the hedging. Hedging is the protection against the foreign currency fluctuation. Bank will lend you the money if they will repay it within a reasonable time, and they will make more for themselves by lending it to you and making you to pay interest than they would from doing something else. So we have to look around, and they uh, apply, which we need to be look around the tested the principles. That's we need to be look around as well for the funding purposes. Good morning, Osama. You okay?
Good morning. Thanks, Mike. Good morning.
Okay, so today we are discussing about sources of finance. We discussed until now is overdraft, and the funding came from internal and external source. We looking each advantages and disadvantages now the sources of funding. So external, we can issue shares. Shares, there are two major categories: debt financing and equity financing. We can categorize. That is mean the like a loan, like mortgage, like leases. We can look around mortgages. Yeah, we can look around leases, and equity is mean shares. Like so we can debt is a cheaper than equity, because the reason any interest you paid is expense for the business, but the shares are the dividend we paid in shape of the return on the shares. So dividend we pay after the tax. So that's the problem we have. So that's really, so that is cheaper than equity. But of course, there is a gearing ratio. We have to look around. Not too much debt, not too much equity. So you need some balancing approach: 60% debt, 40% shares. So that's a good balance approach. So lease can be 5 years, 10 years, 15 years. We can buy the lease. It can be different term. It can be finance lease. So let's say you're getting the car on the finance lease, the car logbook, the car paperwork is on your name, and at the end you can sell it or you can buy it. So that can be, but the advantage is both is costly. Look around the tax purposes as well. So because you have to pay the road tax. So hire purchase agreement, like a hire purchase is like a rent. You hire the car on the hire purchase agreement, HP. And of course, whatever the payment you make, it can be clustered as the expense for your business, but you have to do the budgeting for it. It can be quite expensive method compared to the leasing. Okay, so then next we can look around the mortgage. Of course, mortgage is very, very important. There can be a different packages, like you buy the asset, you buy the factory on the mortgage. It can be the interest rate is quite, is we can look around the fixed rate, flex rate, 2%, and at the moment base rate in the UK. Base rate is called Central Bank of England rate, which is 5%, the base rate. Plus bank always add, their margin, let's say assume 2%, and you can get, of course, it depends upon how creditworthiness you. So it can be rate is a 7% your interest rate. Every £100 you buy, you have to pay every year £7 interest. So that's it. Really, we need to be look around the cost of but the interest what you paid is known as a cost. For the business, so we can claim back in terms of the tax saving. So trade credit, sometimes it's good to be, you have a negotiation skills. You can get the trade credit for 30 days, 40 days, 90 days from the supplier. I'm paying you payments, that help you to boost the cash flows. Discount given on the payment would be lost sometime because the trade credit, maybe if you give the cash, then you will get cheaper good, but if you get on the credit, it costs you more. A lot of government grants available, like if you want to be open business or the website grants, or so we have to look around which industry we are, what the government grants is available. It can be regional grants, like you want to set up the factory in certain areas, so government is carry on providing the grants. Okay, venture capital. The word venture is mean, the pooling the capital, which it can be like a lot of small or rich people, they can pool the capital and they can lend to the company, and that's and then of course they carry on getting the shares on. So that's, the venture capital is a huge, which we can look around. That's, also is administration. And again, is we have to look around. So please, any money you borrow from the banks are always look around the purpose. Like if you're getting the student loan to complete your qualification, that's a progressive loan. If you getting the loan to buy a car, maybe it's not a progressive, because the car itself reduce the value every year. So you have to look around those perspectives as well. So how much is amount you're looking, and ownership of the business, what will be? That's, so your sole trader partnership. Then we have, when you're looking, next we're looking 4.3 to justify the choices are the sources of the funding. So we can look around the capital and revenue. What is the difference between capital and revenue expenses? Like if you're buying a house, it's a capital expenditure. If you're cleaning the house, you're putting the new carpet in the house, that's a revenue. Revenue normally is a low value that goes in the income statement, those expenses. And that's, we can reduce our profit and we can save on the taxes. But the capital allowance, if you're investing in the properties or you buying the car, that's, the capital expenditures, you buying your asset, and you can claim the capital allowance from HMRC. So you have to decide, which one is which, that's, it's the capital expenses. When you sell the current asset, like you bought a building, you sell it, you earn the income, that's your capital income. But if you do daily, you buying and selling goods, that's your normal business, that's your revenue income, which we can look around. Please, Osama, if any question you can ask, please. So next we looking the sources of finance. When we're looking, like we mentioned earlier, equity financing is main issue. Shares, to the different types of shares. We can, ordinary shareholders have the voting right. They can kick you out as a management because we have an AGM, annual general meeting. We always look the tax perspective, like a dividends and things. We need to be the long-term debenture, the medium-term hire purchase, the short-term can be credit, overdraft limit, and the special government grant. These can be all, Other is the right issue. Shares, like you buy one and we can give you one more share. So, and the value of the existing shareholders can be dropped due to, because when more shares will be in circulation, what will be happen ultimately? The value of the shares will be dropped, So you have to think about before, actually you investing in securities and you're looking these, So you have to be effect of these need to be debt versus equity. As mentioned earlier, debt is cheaper than equity. Equity means shares, and the debt means bank loan, mortgage, leases. Debt holders are the higher in the priority repayment than the shareholder. The risk is the low risk of the debt holders, high risk for the company, and the equity is the high risk of the shareholders and low risk for the company. And return, debt holders will accept, lower return due to the lower risk, and equity is a high risk, high return. So normally we use the risk factor is called beta, and it's affecting, debt to equity ratio, which is known as a gearing. Like if you have too much debt in the company, that's a high gear, so maybe you can't afford it to pay back, that company can be liquidated. So that's, which we need to be keep in mind before you deciding and looking these. Then we have a financing for the small and the medium enterprise SMEs. Can be difficult raising the finance, and the small number of the owner will be limited capital, lack of the business history and the proven track record, and the lower level of security, and the funding gap, the difficult to raising finance, and the maturity gap, can be SMEs, small, medium enterprise, and the finance is skewed against the long-term asset than the short-term finance. So these we need to be keep in mind, all these factors. The sources of finance, SMEs, business, angels. Business angels mean the rich people, can be capitalists, government assistance, and supply chain, which we can get the loans on in terms of the goods, that can be used. Okay, other things, please, is always good to be when you do your financing, debt and equity, you use the weighted average cost of capital. You can change the proportion of the debt or the proportion of the shares, and you look around the benefit of the taxes, you look around the interest rate. So V is normally we use this formula, the cost of equity, how much is costing you in terms of the dividend, the cost of the debt 1 minus T, because the T is the tax, we can save the tax on, but on equity we can't, save on the tax, because the dividend we paid after the tax. So VE is the value of market in market, how much the value of debt you have, how much the value of equity you issue. And then whichever the weighted average cost will be lower of all options, you go ahead with the option. So we can use the formula in the financial perspective, and that's I included the quiz, to do to look around the different sources of finance, please. That's which is quite good. I included the videos and these article of the sources of finance as well and the quizzes. Okay, that's quite good to look around. So I'll take you back to. So today really we're looking the sources of finance where we can raise the money. We can look around the setup cost, look around the starting investment capacity, look around the working capital, is mean running capital, how much required. When we looking the business, so always look around the sources, amount is required. You think about your sole trader partnership, limited company, public and the private limited company, and what option you have, and risk is the probability of happening. If you have too much debt, so you have a high probability you can be collapse, sometime, because maybe you can't afford it, in some point. So that can be a huge costly process for the companies. Those we need to be look around in a perspective to, that's which we need to be look around in raising the length of the time that's required. We need to look around the shorter term and the longer term finance. That's it's very crucial, which we have to think about before making a decisions to go ahead or not in terms of finance overdraft. So you have to look around the supplier credit and working capital credit. Long term sources of finance, as we mentioned, mortgage, bank loan, share issue, debentures, retained profit. The previous year profit we can use it for, and that's that we can meet the requirement of the if we need the money for it. Yes. Then we 4.2 we had a discussion about appraise. When we do the appraise long term and the short term or the medium term, always appraisal means check the performance, how much cost in the short run. Maybe you buy the 5-year loan, or if you do the daily overdraft, maybe the money you're receiving from the customer in a few days and you need the loan for the few days, so maybe overdraft is good. Otherwise, if you look in the long term perspective, overdraft is the costly process and that costs you more than the. So that's we had a discussion. We said the working capital always manage. Working capital means the running capital. You look around the current asset, how much in the company. Short term asset mean anything you own it, anything which flow the future economic benefit is your asset, like the inventory, the trade receivables, and anything prepaid and the cash itself. And minus your liability, so you have to be working capital, healthy capital in your business. So you can categorize in the long term, short term, and medium term. And the purpose of it, like short term can be bank overdraft, the trade creditors. Short term bank loan can be factoring, like you have invoice to receive from the customer, but you can give to the bank. You can use that factor. You can, like, £100 you're supposed to receive, but maybe bank is happy to give you £90 on the invoice, and that can be used for, and the bank can get £100 from the customer. So then we discuss about advantages and disadvantages of each source of finance, which I just mentioned you as well. So that's leasing, hire purchase, mortgage, trade creditors, government grants, venture capital, angel capital. Always think about the purpose, the time, and the amount. That's quite crucial. Capital and revenue expenses, we can categorize which one is you buying an asset, are you using for the sake of the revenue to meet like a cleaning, renovate your house. These are, and capital incomes and the revenue income. Those we can look around different sources of finance, long term, short term, that need to be focused. Right issue of the shares, if you issue too many shares, what effect will be on the existing shareholders? That need to be debt versus equity, which we just said. SME, small medium size enterprise, where then, and the weighted average. So your final decision, maybe you can look around the weighted average cost of capital, look around the gearing ratio. High gear, it can be high risk, towards the company, and that's which we need to be keep in mind, before making the decision you want to go ahead, with these. That's Osama. Any question, please?
No, it's fine. Thank you.
Okay, so that's today our topic what the sources of fund, and so we can think about any business you do, look all possible options, cost, benefit, duration is need to be keep in mind before making the decision. So in the next lesson we'll go through LO5, and then following lessons we'll go through assignment discussion. And thanks for attending, and I have a lovely weekend. If you have a question we can discuss, otherwise we'll keep up to here.
Thanks so much. Thanks so much.
Yeah,